Okay, well, let's get started then. I'm not much of a podium person. For those of you who know me, I'm a roamer, so I'm not going to keep myself behind the podium. It's not fun anyway. If you were up here, it's really not fun being behind the podium. It's also less engaging, so I'll roam around as we get started. But before we get started, I know that there are several other presentations that are here, so I thank you all for coming. I saw the list and it looked pretty interesting. I think there's some yoga presentations and some cooking presentations, so I can tell you completely objectively that you've chosen the best one out of all of them. So, so thanks for joining us. Although some of them sounded very interesting, so maybe I'll stick around and see if I can sneak in the back or something like that. But so what I want to do is go over a presentation that really relates to, in some cases, common sense. So what you're going to see is some things that may seem familiar to you, whether you're just a casual reader of the Wall Street Journal or Investors Business Daily or Money Magazine, or I know we all tend to click on CNBC every now and then, and some of us consider ourselves novices, some of us consider ourselves far more experienced when it comes to investing. But what I'm going to do is go through what I feel are some of the most common mistakes that I see. In this case, I tailored the presentation. I mean, I do this presentation from time to time, but what I did was really tailored it more for an audience of women. Because as an advisor who's worked in the industry for 15 years, I see that there are some differences between the decisions that women make versus men make, and some things that are far more poignant when it comes to whether you are a female or a male investor. Without getting too, I think, specific in terms of gender difference, there are some differences that I've noticed. So my name is Jonathan O'Connell. I'm a financial advisor with UBS Financial Services in Riverside. I've been a financial advisor my whole life, and fortunately I had a great mentor. I'm with a great firm, and I'm now a first vice president in the Riverside office, and work with a number of different groups. I work with philanthropic organizations, I work with individual investors, and I also work with corporations. So whether the need be retirement planning, whether it be a nonprofit organization who's looking to manage their endowment resources, or whether it be a corporation who's looking to manage their portfolio in a way that mitigates risk. I'm fairly broad in terms of the clients that I help. But my primary base of clients are people like you. So I've had literally hundreds, if not thousands, of meetings where I've sat down with people just like yourselves, and we've had that very intimate conversation. Money is a very intimate topic. Oftentimes, I think clients share with me things that make me, maybe sometimes I'm wearing a therapist hat, and sometimes I'm wearing a financial advisor hat. But money is a very intimate subject, and it's often something that's not shared with many people outside of your circle of your immediate family. So when you begin talking about the true goals and objectives of somebody, you learn so much about not just their personality, but also their history, how they grew up, what their greatest fears are, what keeps them up at night, and ultimately what their legacy is that they want to leave behind once they leave their estate to their children. So again, circling back, I'm going to go over some of the common mistakes, follow some threads that follow some of the common mistakes that I see investors make, but I did tailor this a bit more for female investors. So I'm going to start simple, and then I'll get a little bit more specific. Some of this might be redundant to you. You might have seen some of these things in the past. It might seem like common sense, but believe it or not, common sense doesn't always come into play when it comes to investing. What you may think you should have done a year later, you didn't do. Because whether it be emotion or whether it be outside noise, it's sometimes hard in the face of especially hard decisions, volatility, fear, to make decisions that are objective and not emotion-based. So the first thing I want to start off with is just basic concepts. So the first concept I wanted to talk about in terms of the top 10 mistakes that people make, the first being pay yourself first. Does anybody have an idea what that might mean? Pay yourself first? Right, right. So there's a few reasons why pay yourself first makes sense. First of all, what's the biggest erosion to your earnings or your estate? Taxes, exactly. So we know that the tax man comes inevitably, whether it be saving money in an IRA, 401k, any sort of qualified account. We know that eventually taxes are going to come into play. So what we want to do is we want to defer taxes as long as possible. So how many of you have had or have a employer-sponsored retirement plan? How many of you have heard of an IRA account? Okay, those two vehicles are your best option when it comes to paying yourself first. So what that basically means is, and the slide I have up here relates to 401k investing, but it also translates into IRAs. What I want you to do is I want you to make sure that every single year that you're working, you're paying yourself first. What that means is you're deferring taxes on as much income as possible. You're keeping as much as your money for yourself and not paying it out immediately to the government. So if you're currently employed and you have an employer-sponsored plan, maximize your 401k contributions. Save till it hurts. I was presenting to a group of people yesterday, and the analogy I used was going to the gym, right? We all don't like going to the gym, but we know that the long-term effects, there's probably somebody in another room speaking about exercising, right? And the long-term effects of that. Well, we know that going to the gym and getting there is often the hardest part. For me, getting there, actually getting in my car and driving there is the hardest part of my entire routine. Once I actually get in there and start going, it's quite a bit easier. So when it comes to investing, it's the same concept. You want the money to be there later in life. We know now that Social Security does not expect you to live off of Social Security. What they expect you to do is to use that as a very small portion or a marginal portion of your overall retirement needs. So the onus is now upon you. When my grandfather retired from Sears, he got a gold watch, a handshake, and a pension. He and my grandmother went to the Bahamas, had this great little island. I mean, I don't want to exaggerate. I mean, it's not like they had their own island, but I mean, they lived on this little island near Nassau, and he had his pension check that came in from Sears, and they really lived this, sweet life. Well, the pensions have gone away, and the responsibility has fallen upon us to make sure that we're filling in these other areas of this pie chart that Social Security is not filling in. We know that inflation is our biggest enemy. And we know that as inflation goes up, and we know that the cost of living goes up, we too need to be saving more. And what this chart shows you is that pensions, you had a question?
What's the maximum amount that you're allowed to put away?
That's a good question. It depends if you're over 50 or under 50. If you're in a 401k plan, the most you can put in, I believe now, is $23,500. $17,500 if you're under 50, right? So what they call that is a catch-up contribution if you're over 50. What they're saying is, we know that you're getting close to retirement, so we're going to give you an extra $5,000 in additional contributions you can contribute out of gross income to put away. So if you're over, that's in a 401k. And that's the benefit of participating in your company's 401k versus an IRA account. If you have a choice, choose the 401k. Your company might match your contribution. They're paying the fees as opposed to you paying some of the fees that you would pay in an IRA account. In an IRA account, it's less, far less. I believe it's $6,500 for somebody over 50 and $5,500 for somebody under 50. SEP is much greater. So a SEP is a self-employed pension. So a SEP IRA is an IRA specifically made for somebody who owns their own business. A SEP IRA has much higher contributions, but that contribution limit is actually a function of how much money you make. And you'd want to talk to your accountant to find out exactly how much. Typically speaking, it's the lower of 25% of your gross income, or roughly $45,000. That number is adjusted, though, depending on your income. So for a SEP, if you're self-employed, the SEP is the better option, but you want to find out exactly what the max contribution amount is from your CPA.
I just recently bought Tony Robbins' new book.
Uh-huh.
Have you had a chance to read it?
I have not read his new book, no. I'm going to put on this, do you know Dwyer? What is this? Wayne Dwyer. Yeah, I started reading some of his, I read online. I don't really read, I don't read hard copy books. I read some of his material lately, and so I've kind of been on his kick lately. But he has some interesting things to say, but Tony Robbins also does too.
Tony seems like, I haven't read the whole book, but it seems like he's kind of going against the 401k and saying that you should really invest more in the S&P to really make the money.
Well, a 401k is a vehicle, just like an IRA, right? So if imagine it as a bucket. You can place different investments in that bucket. Oftentimes a 401k is going to have a whole menu of different options for investing that your company will provide.
Can't you invest in the S&P?
You sure can, right, absolutely. So you can invest in an S&P 500 fund in the 401k account. So your investment options are broad, and we'll talk about that in a second. But when it comes to the basic concept of what I'm talking about and pulling it back to my number one mistake, I see people who don't pay themselves first. Oftentimes people think because I'm not working, I can't contribute to an IRA. Not true. If your spouse works and you don't, you can still contribute to a spousal IRA. So you can still make a contribution to an IRA that matches what anybody else could make, even though you don't have earned income, as long as your spouse does. Keep that in mind. Most people don't know that. So I want to see every couple contributing all the way up until retirement, and even in some cases into retirement. Money either into your 401k, or 457 or 403b. Those are some different tax codes depending on if you work for a public or private entity. I want to see you use that first. If you don't have that available to you, I want to see you use an IRA. Yes?
For tax implications, if you retire,
Yes.
are you still able to put money away into retirement?
So long as you have earned income. Earned income is defined as not dividend or interest income or income that you get from a rental property. It's earned income. It's W-2 income or 1099 income, income that was actually earned. People might work in retirement. Retirement's a completely different definition today than it was 20 years ago. So long as you have earned income and you're retired, you can contribute as much as you earned. I have some clients who will contribute all that they earned into a 401k because they're at that stage of life where their kids are out of the house, maybe they paid down, if their kids are out of the house, they maybe paid down their house, they don't have as many expenses, and they're really trying to shelter as much money as possible. So yes, you can, in retirement, you can make a contribution.
So did you just say rental income is not earned income?
It's not earned income, no, it's passive income.
What about a pension? If you get a big pension, can you put money from a pension?
It's, pension's not earned income. It's income that's it's earned, right? I mean, you're continuing to work, so it's W-2 income typically, but it could be 1099 if you're an independent contractor.
What if you're retired and you're getting your pension, but you can't put money from it?
You still could if you have pension income, and then you go back into the workplace as a consultant or something. You still could make a contribution. Yeah.
But only to the amount that you earn.
Correct. The IRS doesn't allow you to contribute more into, say, an IRA. In that case, it would be more like an IRA or a SEP IRA, that you can't put more in than you've earned in earned income. There's really not, actually. The one caveat is that once you achieve age 70 and a half, the IRS forces you to begin taking the money out. They want their money. And what they say is, we've given you the benefit of tax deferral growth over the course of your life. But at age 70 and a half, we think you're close enough to retirement age where we want you to start drawing money out. So they have a table whereby you calculate based upon your age and the balance in the account how much you need to take out. They force you to take it out. If you don't take it out, you pay a 50% penalty on it. It's quite severe. So once you reach 70 and a half, they demand you start taking that money out and paying income tax on it. But chances are you're in a lower tax bracket when you're retired than when you were working. So it still makes sense to make the contribution earlier and pay the taxes later, and you're getting deferred compounding growth. I always use the analogy of a snowball starting at the top of the hill. You want that snowball to be as big as possible at the top of the hill, and as it rolls down the hill and accumulates more and more mass, it will be larger at the bottom if it started larger at the top. That's where you're saving gross income versus after-tax income. So that's why the 401k and IRA makes sense versus just earning the money, having your employer withhold the taxes, and then going and opening, say, a brokerage account. Not to say I oppose that, but I want you to pay yourself first. And those options make more sense.
So it sounds like you're not a big fan of the Roth IRA.
It's not that I'm not a big fan of the Roth IRA. I find that those that benefit from a Roth IRA are in the minority. They're people that anticipate being in a higher bracket later in life. And most often I don't run into people that are in that situation. I myself don't contribute to a Roth IRA. I put all of my money into, I need to mitigate my tax liability now in my working years, more so than I will when I'm probably in my 70s. I'm not a big advocate of, we shouldn't say I'm not a big advocate. I think I am in the right situation. I just find that the majority of people benefit more from a traditional versus a Roth. And in a 401k, you might have a Roth option. I'm not going to digress too much, but some 401k providers allow also a Roth 401k as well, where you're contributing after-tax money instead of pre-tax money to your 401k. But again, I don't see many people that are in that situation.
So if you're in a position where pretty much all of your investments are pre-tax, when you retire, you don't see that as an issue because you think that your retirement income can be low?
Well, your earned income is going to be lower, and you're most likely going to be in a lower bracket. There's no definite way of predicting the future, but I do know that the compounding rate of return on gross income versus net income is going to lead to a larger balance at the end of retirement. And you're going to pay taxes on that, but in many cases, I'd say in 90% of the case of my clients, they don't actually spend all of their money. Though they don't know when they're going to pass away, right? And so what they do is they're very conservative. They only use money that they have to out of their qualified accounts, and they take what they have to once they achieve 70.5 because the IRS forces that. But it's really more of a benefit, I think, and I think it's broadly agreed upon. There's a consensus that says that getting the tax benefit now and saving gross income makes more sense, especially if you're in a 401k where your company is matching your contribution, they're covering the costs. It's also a more disciplined way of investing as well. I mean, frankly, if you ask somebody to save money after they've already paid taxes, the money gets direct deposited into their account, and then they go out and have the onus of saving the money themselves. It's much more difficult, just from a basic, human standpoint, to have the self-discipline to do that versus having your employer defer it from your paycheck. So we're on number one, and I've got to get through the next few. So they all relate. The other, I think the second mistake that I wanted to touch on that we really already have is not relying on Social Security. We've already touched on that, and that slide that I put up earlier really speaks to that. If you think that Social Security is going to be your sole funding vehicle, you're absolutely wrong. The future of Social Security is absolutely in flux, and most likely you're going to see, not to get into, not to bore you too much, but you've got the discretionary and the non-discretionary portion of the U.S. budget. Our administration and Congress, they've been very, very good at attacking the discretionary portion of the budget, things like military spending, other things like that. What they haven't touched really and haven't really amended, which needs to be addressed because it's such a large portion of our budget, is the non-discretionary portion. That's Medicare and Social Security. We can't afford to continue on the same path that we're on right now with the current benefits we offer through Medicare and Social Security. Unfortunately, if any politician talks about amending that, they're pretty sure to probably not get elected. So it's a very, very touchy subject. And so they don't want to touch it, but they're going to have to at some point address it because we're going to see the benefits of Social Security and Medicare change, where most likely it's just going to be something mild, like the age of qualification just bumping up a little bit. So, being 65, 66, and 70, you would probably go up, or 63, 66, and 70, you'd probably bump up a little bit, maybe a year or two. But people are living longer, and the funding that was assumed when Roosevelt created Social Security was that people would live far, not nearly as long as they do now. So it does need to be amended.
So, given that, is it better to try to withdraw it earlier at 63 or
Good question.
or later?
That's a very, very individual question. So I couldn't give a broad recommendation. That's where a conversation, I think, with financial advisors is critical, because you have to look at your own situation and decide whether the benefit of getting it now outweighs the benefit of getting more later. It really depends on how much you need and whether you're willing to sacrifice that additional benefit in taking it now. The third mistake that I often see is people who don't necessarily, I'm trying to think of a good way of explaining this, and this is really where I tailor this more to my female clients that I meet with. Oftentimes, if they're widowed, if they're divorced, or even if they're married, there seems to be oftentimes a gap, a separation between one spouse knowing more about finances and retirement than the other. And I don't want to generalize, but in many cases when I have a couple, when they come in, one sort of has that deer in headlights look, and it's not always the woman by any means. I mean, oftentimes it's the man too. But one of them has a deer in the headlights look, and they're just sort of there to be present, but not really aware of what we're discussing, because they've really relinquished the ownership of that responsibility to the other spouse. That's something that if you are feeling as though, and if you're not well versed in your current retirement strategy that you have, you need to be active in that. The first thing you can do is to educate yourself in understanding what it is you should be aware of, right? I mean, if my wife and I were engaged in some sort of, in planning a trip, and she had gone through all of this work with AAA to plan this trip to, I don't know, say Hawaii. And I knew nothing about Hawaii. Well, how could I begin to get involved with planning the trip to Hawaii if I really know nothing about what there is to do in Hawaii? So I'd most likely go out and go online and read about Hawaii and see what there is to do, you know, swim with the dolphins or snorkeling, whatever it is you do in Hawaii. And then I'd go about into the conversation with the agent at AAA and say, well, here's some of the things that I think we should be doing as well. It'd be a conversation. This is something I want you to do. If you're not already subscribed to some sort of investment periodical, that could be as simple as Smart Money. It could be one of my favorites, Barron's, which I'll stand up and say that that is my absolute favorite periodical for learning about investing. It's not overly technical, but both financial advisors, analysts, and investors just like you subscribe to it because it's a very easy read. It comes weekly, and it's not that expensive. Barron's, B-A-R-R-O-N''S. That's the best one in my opinion. Very objective as well. The Economist is great for more of a macro type of approach. Very non-political, very objective. Investor's Business Daily, which I'd actually recommend more so than the Wall Street Journal. Wall Street Journal is more news, where Investment Business Daily is more for investors. Don't take your information from CNBC. I mean, I'll stand here and say that. I think CNBC, remember what their priority is. It's selling advertisements, it's selling ratings. I think they've become far more of a source for leading you down the emotional path of investing, which is what you absolutely want to avoid. You don't want to let your fear dictate how it is you invest.
Question.
Yes, ma'am.
So overall, as far as a long-term strategy, you would prefer a mutual fund versus individual stocks?
Good question. Yeah. Individual stocks can be. It's a good question. I'll say this: 98% of investors use mutual funds for the core of their retirement savings vehicle. There's a reason for that. Mutual funds offer diversification that you don't get by trying to diversify through individual stocks. I remember when I was in undergrad and I was taking a finance course, I was a really, really smart professor, and he actually told us that unless you have 48 stocks in specific industries that are non-correlated to each other, that you cannot achieve the true diversification that's actually available to you as an investor. So the thing you can do to help yourself, you can't control where markets are going. You can't control where the economy is going. You can't control things like the recession or a housing market dip or all these other things. What you can control is diversification. You can manage the risk in your portfolio. You can materially lower the risk in your portfolio through diversification. So what mutual funds offer is the diversification that is one of the things you actually can control. If anybody watches Jim Cramer on CNBC, he always talks about that. The one thing you can do for yourself is diversify. If you're not utilizing that tool, then you're really wasting the greatest tool you have when it comes to having control over your portfolio when there's so many variables that you can't control. So I do advocate mutual funds over individual stocks, simply for diversification. Individual stocks, I'm not opposed to owning, but oftentimes I'll have clients who will have a pot of money that they set aside that might be 10% of their overall portfolio because it's more of a hobbyist type of thing to them. They'll read about something that's interesting. They might work for a company that's interesting. They have a son or a grandson or a sister who works for a company who has a very interesting product coming to market. Let's say GoPro, which is a really popular thing right now. I've had several clients call and they've said, GoPro sounds like a really interesting company. Maybe I should buy some shares of that. So it's not to say that I don't advocate buying stock, but for the core of your portfolio, I'd say 80 to 90% of your portfolio, I would recommend professional money management versus picking your own individual stocks. Yes, I do. So again, I'm going back to the taking ownership thing. Be your own advocate. Take ownership. Understand what it is, what's happening in your portfolio. Demand from your spouse if you are not that person who's running your money. And if you are, talk to your spouse and get them involved as well. You never know when some sort of life event is coming. That could be the passing of a spouse. It could be a divorce. It could be one of a number of different things that will materially suddenly change your retirement plan. And if you're not aware of what your plan is and you're not involved in that communication with your financial advisor, you really have no excuse when the time comes and now perhaps you lose a spouse or the relationship doesn't continue, then if you're left out in the dark and you suddenly realize, you know, I don't really know what my spouse's Social Security benefit is, where if they were to pass away, I can take their Social Security benefit as opposed to mine if theirs is higher. You need to know these things. And if you don't know them, work with a financial advisor. But another thing is, read some sort of periodical that's educating you every single week to learn more about the topic. Barron's is great. Investors Business Daily as a newspaper. Not CNBC. Actually, Bloomberg, which is a really boring TV station, is actually better than CNBC because they're quite objective and not so fear-based. I also think that the Smart Money, Kiplinger's, is a great magazine. So here's just one of them, and just get one every week and educate yourself. So the other topic I want to touch on, and the most common mistake, is starting early. So easy, start early. Now, many people that I talk to, when I talk to groups, I'll talk to somebody in their 50s or their 60s, and they'll say, well, it's just too late for me. I should have started when I was 20. I know now that I should have started when I was 20, or in my 30s, or in my 40s, or if they're in their 70s, they say I should have started in my 50s. So it's all relative. But it is all relative. I was at a presentation yesterday, and there's this really neat slide where it shows, you've heard this before, and I'm not really big on this because there was a book that was written called Smart Women Finish Rich. I'm not sure if you've ever read the book before, but there's a chapter in that book that talks about if you just took the money you spent on a Starbucks, a cup of Starbucks every day, and saved it, well, you'd have $20,000 after 10 years. Well, who's going to do that, right? I mean, it seems that that's a little bit impractical. But what was amazing was the actual concept itself is powerful. If you saved $10 a week, $10 a week, whether that be into an IRA account, into your 401k, any one of us have $10 a week in discretionary money, in gross income, because that's like $7 a week in actual net income, and save that every week for 52 weeks a year at a compounding rate of only 6%, which is fairly realistic in today's economy. After 10 years, you'd have over $19,000, and after 40 years, so if you were to start in your 20s or 30s, after 40 years, you'd have over $84,000. Now, that's powerful. Another slide that I've seen compares two people, Tom and Jerry. Tom puts $2,000 away, starting at age 18 to age 24, so roughly for 7 years. That's it. Remember, it's every year, so 18 and 24, you think, well, that's 6 years. It's actually 7 years. And then you've got Jerry, who puts the same $2,000 away, starting at age 24, every single year until Jerry retires at age 60. Tom never puts another dollar away after age 24. He only put away $2,000 between 18 and 24, so he saved $17,000 or $14,000, right? 2,000 times 7 years. Where Jerry put in far more, $2,000 every single year from age 24 to age 60. Do you know that based upon the same 11% rate of return, which is a historic average of the S&P 500, that Tom, who put away only $14,000 but began earlier by 7 years than Jerry, ends up with a higher balance at age 60? It's amazing. So we know that starting early is the most important thing when it comes to saving. And if you think that you're too old now to start early, I'm at the age now where there's no point in doing it. I'd argue that that's a relative concept, and that putting money away is always important regardless of what your age is. Not only does it create the discipline, but also prevents you from seeing that money as accessible for things that aren't necessary. So this actually shows, this is an example also of monthly savings needed to accumulate $1 million by age 65. And you can see that even for a 55-year-old, if you were to save $5,000 a month, which if you're a highly compensated person, you could. But let's be realistic. If you're in your 40s, you could save $2,000 a month, right? The $1,900, that's gross income, remember. It's not net income, it's gross income. But what we're seeing is more and more individuals who work 9-to-5 jobs. I have many teachers who are both very disciplined in saving that are millionaires when they retire, because not only did they count on their pension, but they also put money into their TSA, which is an employer-sponsored retirement plan for teachers.
Jonathan,
Yes?
is there a book or something for young people like the kids that are
Yeah.
that we can start teaching the younger children
That's a good question. 20s or even high school or college, what I'm finding is there's a tremendous gap between the financial knowledge of the generation that is in both their 40s and more importantly, the baby boom generation. So you have this gap, and I'm not telling you something you don't already know, but unfortunately I'm not sure what, I have different theories about it, exactly why it's happening, but the generation of 40-somethings, 50-somethings, 60-somethings, and up seem to be far more financially well-versed than those that are in their 20s. Money's not taught in school, right? Financial management's not taught in school. You're not even taught, I have some clients who don't even know how to write a check until they're forced to learn how to do it when their spouse passes away. It might sound foreign, but it's a true story. And so what we're seeing is high schoolers, people in college, people in their early 20s have really extremely low financial literacy. And there's no real resource for them to achieve that financial literacy because the colleges aren't teaching it, the high schools aren't teaching it, elementary schools aren't teaching it. In fact, if I had more time, something I've thought about is creating some sort of nonprofit organization that would teach like a financial boot camp for kids where parents of high schoolers or junior high kids would send their kids to this day camp, right, for a couple of weeks. They'd go to this day camp. They'd learn things like the power of compounding interest. They learn about interest rates on credit cards. Right? That's the biggest mistake people make when they go to college. First thing they do, right, when they check in for college is they see all the credit card booths and they're ready to give them a $400 limit credit card with a 25% interest, and they think, wow, $400 is free money, and then they're paying $20 a month on that $400 balance for the next 4 years, and then they graduate with a $400 balance on their credit card. So, we see it all the time. But there are a couple of good books. I would say that some of the periodicals they already mentioned, if you could give a great gift to your children or your grandchildren, get them a subscription to Smart Money Magazine, which is probably an easier read, or to Barron's. Another great idea is for you to get them, instead of buying them something, whether it be a toy or a GoPro or something like that, buy them shares of equities. I have clients who call and they buy 5 shares of Starbucks. They want something that appeals to their grandchildren or children. They want something that they can actually relate to. If they bought them 10 shares of Micron Technology, it probably wouldn't go very far. But if they buy them 10 shares of Coca-Cola or Nike or Disney, or GoPro, then they're going to be much more interested in, well, what's this all about? I actually own some of the company. How does that work? I actually own some of the company. And then they gift those shares to them. So that's powerful. I think giving them as a gift a shares of stock is important and is probably the most worthwhile thing in terms of teaching them financial literacy. In terms of books, I think there's a book called One Up on Wall Street that was written by Peter Lynch, if you want to write that down, back in the 80s. Probably one of the more famous financial books where he takes very simple concepts. He was a very famous mutual fund manager for Fidelity Investments in the 1980s and 90s. He ran a fund called the Magellan Fund. And so he began, people asked him, what's your secret? Tell us about your technical quantitative theories and your calculations as to how you've achieved these great results. And he said, actually, it's not that complicated. I pick companies that I'm familiar with, that I know have good products. The management is good, and it's not that difficult. And that book actually talks about investing, and it talks about the basic concepts of investing. One Up on Wall Street. It's been out for 20 years. In fact, it was one of the books that I read in college when I took economics that got me into finance.
What was that like?
Peter Lynch. Peter Lynch. One Up on Wall Street by Peter Lynch.
I think the U.S. savings bonds are going down so much.
I wouldn't buy U.S. savings bonds. In fact, I'll digress here again, and I'll say that you need to be aware that bonds aren't always the safe, risk-free investment that they're advertised to be. What that means is you want to have bonds in a diversified portfolio, but understand that U.S. savings bonds, as a great example, we're in a very low interest rate environment. If you go buy a house, you're aware, I'm sure, that interest rates are near an all-time low, right? Well, that translates also into the interest that you're getting from the bank. I mean, raise your hand if you've made any more than 1% on your savings from the bank in the last 6 or 7 years. You haven't. So the banks are issuing bonds because they're paying less on their savings. They're also paying less on savings bonds. The rates are so low that when you actually calculate what's called real return, not nominal return, but real return is calculated as rate of return minus inflation. Well, we're at about 3% inflation right now. It's not that high, but it's still higher than what you're getting on most savings bonds. So you're actually achieving a net loss. If you've got cash sitting in your under concepts of investing. One Up on Wall Street. It's been out for It's been out for 20 years. In fact, it was one of the books that I read in college when I took economics that got me into finance.
What was that like?
Peter Lynch. Peter Lynch. One Up on Wall Street by Peter Lynch.
See the US savings bonds going down so much.
I wouldn't buy U.S. savings bonds. In fact, I'll digress here again, and I'll say that you need to be aware that bonds aren't always the safe, risk-free investment that they're advertised to be. What that means is you want to have bonds in a diversified portfolio, but understand that U.S. savings bonds, as a great example, we're in a very low interest rate environment. If you go buy a house, you're aware, I'm sure, that interest rates are near an all-time low, right? Well, that translates also into the interest that you're getting from the bank. I mean, raise your hand if you've made any more than 1% on your savings from the bank in the last 6 or 7 years. You haven't. So the banks are issuing bonds because they're paying less on their savings. They're also paying less on savings bonds. The rates are so low that when you actually calculate what's called real return, not nominal return, but real return is calculated as rate of return minus inflation. Well, we're at about 3% inflation right now. It's not that high, but it's still higher than what you're getting on most savings bonds. So you're actually achieving a net loss. If you've got cash sitting under your mattress, in your safe, if you have a large balance sitting in your checking account or savings account, I know cash is king. I know it adds a lot of security to you knowing that you're not taking any risk with it, but realize that you are losing money every single year. And that 20 years ago, a gallon of gas was a little over $1 a gallon, and now we're celebrating the fact that it's $2.50 a gallon. It's a very good example of inflation. So the cost of living keeps going up. You've got to do something. You remember, retirement is probably going to be a 30-year process. Everybody in this room is going to live a lot longer than they think they are. I'm telling you that right now. Because I have clients all the time tell me, I was supposed to be dead 10 years ago. I wasn't expecting this. Or some clients will say, when I had my double bypass surgery, my surgeon told me that I had 10 good years. So I was planning on living 10 years. Well, now it's been 20 years. But thankfully, they've been conservative and they've made the right decisions. But you're going to live longer than you think you are. Inflation's going to go up. It's going to make the cost of living a whole lot higher 20, 30 years from now. $40,000 today is going to have the same, I should say, 10 years from now, $40,000 is going to have the same purchasing power as $55,000. So what are you doing to grow your estate, to grow your investments, to keep up with just the cost of living? You have to do something. So U.S. savings bonds are a bad way of achieving the same returns needed to at least offset inflation.
So if you were given some as a kid, should you hang on to them or should you cash them in?
I think you should cash them in and buy something that has more growth potential. If you're getting 4% on a bond, you bought it a long time ago. And yeah. Then perhaps if you're getting 4%, that's a pretty good rate of return. But inflation's 3%, so you're still kind of breaking even. But for somebody who's young, they have a long-term time horizon. And we know that the economy is expanding. Look at any major corporation in this country, and it's had bumps along the way, but they're earning more and producing more. So I'm a big advocate for investing in growth investments. And while we do know, and I'm going to show that to you in a second, that there are bumps along the road, it leads me to my next biggest mistake, which is stay the course. Diversify. I'll touch on this one, but then I'll get to staying the course. But diversification, and we talked about that with your question about mutual funds versus stocks. Why is diversification important? Well, we can see that a portfolio here where you talk about bonds, a 50-50 portfolio, and stocks over the course of the last roughly 30, 40 years, bonds have done well because in this period here, you had significant appreciation when interest rates were going down. When interest rates go down, bond values go up. But you could argue that bonds have peaked in value and that you should be looking at taking profits in bonds. In a 50-50 portfolio, what you get is less volatility. It's more predictability. And while you may not have the types of returns you have in a great year like last year that the stock market had, you're getting more predictability. So diversification, going back to your question, I already touched on this, which is one of the top 10 mistakes, is investors don't diversify. They concentrate their position. They concentrate their position in a handful of stocks. Those stocks don't do well. The S&P 500 might do well. Then they call me and say, well, why did we do so poorly when everybody else is saying they made money? That's diversification. I'm not going to get into these two slides because we're a little short on time, but this just compares a 100% stock portfolio, which if you take a look at this, and I'll highlight a couple things, the worst of times versus the best of times from a 100% stock portfolio versus a 40% a 40% bond portfolio and a 60% stock portfolio, which as a very general rule of thumb, your portfolio, the amount that you have in bonds should match your age. Now that's evolving a little bit and may not necessarily be true, and I'm not going to make a blanket recommendation like that because it really depends on your individual situation. But if we were to take an old tenet when it comes to investing, having your age match the percentage that you have in assets outside of stocks is a pretty good tenet to live by. But you'll see a 60-40 portfolio has a much lower dip, but a lower rate of return during the good times. So it tends to make things more even keel, and that's what you want when you're investing. Rebalancing is important too. That's one of the mistakes people make. They invest in a portfolio, and then they don't look at it for a year, 2, 3, 4, 5 years. You want to rebalance. You want to harvest profits. We know that markets are cyclical. Oil is a great example. Look at oil right now. Oil's $45 a barrel. In 2008, 2009, it was $120 a barrel, and Goldman Sachs was predicting it was going to $200 a barrel. You always want to harvest, take profits in your portfolio, and actually take from what's done best and rebalance among the things that have not performed as well. Sounds counterintuitive, right? But remember, as humans, going back to the caveman days, we were taught when we saw a jaguar or a saber-toothed tiger or some sort of lion that was attacking us as we were hunting and gathering, our first instinct is to turn and run the other way, right? That's human nature. That's the emotion of investing. Behavioral finance is actually something that's becoming a major, an undergraduate degree that's being taught in some Ivy League colleges because they're understanding that the behavior has so much to do with how returns are produced. Between 1983 and the year 2000, that was a 17-year bull market, the greatest this country has ever had. The average return on the stock market was 14%. The average investor during that same 17-year period averaged a rate of return of just shy of 5%. Why did that happen? Because they were constantly making decisions based on fear. They saw the saber-toothed tiger, which was the crash of 1987, the crash of 2001, the crash of 2008, and they said, forget this, I'm turning around, I'm running the other way. Do not do that. I know it sounds simple. You've heard this before, but you've all done it. And so if you're making decisions based on fear, which is why I say turn off CNBC, and you're not taking profits from those things that have done better, which is counterintuitive, selling high, buying low, well, that's what you're supposed to do, right? But oftentimes you fall in love with your portfolio and you say, well, I want to sell the losers, the ones that lost money, and I want to put more money into the ones that have made money. It's not the right approach to investing. Warren Buffett said, be aggressive or be opportunistic when, I'm paraphrasing, but when people are most afraid, and be afraid when people are most optimistic when it comes to investing. And Warren Buffett's a pretty smart investor. But that's the time that you should be afraid. Right now, we're going through this oil crisis. The market started off on the bad foot this year, and many people are saying, yeah, maybe I should be taking money out of stocks. Maybe I should put money back in cash. Not the right approach. Not the right approach. So finally, my last yeah, take profits. So harvest your gains and redistribute them at least once or twice a year among the parts of your portfolio that haven't done as well. And I know we're on the last minute or two. Finally, I'm going to go over the last couple relatively quickly, but I want to talk about this. This is talking about recovery and why you should stay invested, stock market performance after recessions. Stock market does best after times of crisis. Staying invested, staying the course. I want to talk about estate planning. So I have to spend at least a minute on this. Many of you do not have an estate plan. What is an estate plan? It's a medical directive. It's a trust. It's a pour-over will. It's going to a good estate planning attorney and having them write up an estate plan that makes sure to ensure that your kids or your beneficiaries aren't put in a very difficult position if you were to pass away. And no one ever thinks that their time is going to come. But I can tell you that if you haven't taken time to sit down with an estate planning attorney to create an estate, and many people think that trusts are only for very, very wealthy people. That's not the case. If you have an estate over $150,000, which is the amount that the state is going to allow you to pass to your beneficiaries without going through probate, If it's over $150,000 and it's going to your kids, it's going through probate if you don't have an estate and a will, which means it's going to get stuck in Sacramento for a year. You're going to pay probate court costs. Your beneficiaries are not going to have access to the money. And it's very cumbersome because they'll probably end up paying additional fees and taxes that they never would have had to pay. So see an estate planning attorney and have a trust drawn up, something that is specific. Who gets what? Who is your successor trustee? Who takes control of things and making the decisions? Because if there's one thing that I've seen, and I have clients that are brothers and sisters who do not talk to each other at all. They don't talk to each other at all because there is confusion as to what mom and dad wanted when they passed away. And now it's created a divide that mom and dad never would have wanted in their family among the siblings that is irreparable and has continued to be such for years and years and years. So see an estate planning attorney. Drop an appropriate estate plan that includes a trust, a pour-over will, and a medical directive. You want your kids to know what they should do if you're in a situation where you're incapacitated and you can't take care of yourself. You want your kids to know where the money is going to go. If you're philanthropic, you want to make sure you've carved out a portion of your estate to create a legacy, to give to a philanthropic organization, and that you're not just leaving it up to your kids where you say over dinner one night or over Thanksgiving dinner, hey, by the way, when I pass away, give 5% to St. Jude's. That's not the right approach to doing it. So with that, if there are any questions, I'll take them I know you've got to go, but any questions, final questions about my presentation? My email address, if you'd like to send me questions or if you'd like a copy of the presentation, my email address, again, my name is Jonathan O'Connell. My email address is Jonathan, seems pretty simple, so Jonathan's Jonathan O'Connell, OCONNELL, at ubs.com. And I'll be happy to answer any questions that you have or to shoot you a copy of that. Jonathan, Jonathan O'Connell, OCONNELL, at B as in boy, S as in Sam.com. So thank you everyone for attending. I hope this was insightful and you learned something. Thanks very much.